into an exceptionally strong portfolio in our non-par whole life, our T100, and actually our level universal life as well. We've really sharpened our pencil on the permanent solutions available by Beneva. And this is a huge value add. I should give you a lot more confidence in some of the conversion options. Maybe you have clients who don't love the complexity of universal life. We now have a whole host of very competitive options for your clients. What we're going to go through today is our new superior value whole life products, a little bit of ideas or a concept or two in our personal or corporate market, kind of a case study to showcase those. We're going to go through the features and show why it's so valuable to have this new product available. We're going to take a look at the new software and go through the options for conversion. So without further ado, let's get moving in today's session. I should probably highlight some changes that have been happening organizationally as well, and nothing major. Key things we'll see, we've got some updates coming in our online application. Some of you may have seen it continues to upgrade. We will be doing some, albeit fairly small, point of sale approvals in the next coming weeks. That's going to open up some additional questions in the online application. So keep an eye out for that. It is intentional. It is happening. There are changes and it will be announced momentarily. We've also got a great GIC promotion rate that I'll showcase at the end of the session, and we'll walk through this program today. So let's move forward. And we've got some of the features and attributes of our new product portfolio. Key things that I think is a little bit overdue, but the biggest thing you're going to notice on all of our permanent products is we've lowered the premiums. I think this is kind of expected by many advisors out there. The story we've had at Beneva for a long time is we're very competitive, we're client focused, we're mutual, our target ROIs are a little bit lower than some of our competition. And as we've been showcasing or reviewing some of the products from the portfolio, we've discovered that we could sharpen the pencil in a few areas. You'll find quite a substantial reduction in some of the premiums on our permanent products. So this is great news for our clients and our advisors. What's really unique is the fact that we've actually managed to enhance our cash values on the 20-pay product, even though we've lowered the premiums. So we really have taken a lead in some of these marketplaces. What's important as advisors to know is that Beneva is focused on the end client and trying to really showcase strong value in the products. We haven't taken anything away, but we have added a fair amount here. So benefits for the client, we can say things are more accessible because it's more affordable. You can actually get into our whole life products or our products that have guaranteed values at a much lower cost. Okay, that higher cash value gives you a lot of flexibility and ability to do things in the long term, whether it be take a premium holiday through an automatic premium loan, whether it be take a policy loan to get the bulk of your premiums back, or potentially if your needs change to cash in the policy. We'll even highlight now when the crossover period happens that the guaranteed cash value in the contract is higher than the total cumulative premiums paid. Huge value, very strong components, and this should be an exceptional component. So we want to showcase a few things. We've actually added names. It's something that I'm not a huge fan of, but I think it is important. One of the things that really makes us stand out in our term portfolio, that Term Plus name, because we're not just another term product, we've got a bunch of added bells and whistles incorporated into it. We've done the same thing or taken the same approach with our new whole life product. We're calling it the whole life superior value, whether it's superior value 20 or superior value 100. They do have paid up options as well. So we made the name of the underlying permanent product a little bit more complicated, but it does highlight that it is an exceptional value product for your clients. Currently, in many markets, we are the best price available, but what is exceptional is the cash values in them are exceptionally high. So hopefully that will be seen as value. We've tried to simplify things as well. The child rider, we made the child's life insurance rider because it didn't designate what type of rider it was. So we tried to, I guess, uncomplicate that by incorporating life insurance to it. And the children's endorsement benefit, those of you that work with us and have for a long time know that that's our critical illness rider for children. But we thought it was a little simpler to just call it a critical illness insurance rider, a child CI rider. So it makes things a little bit simpler for our clients and advisors who might be newer to Beneva. There's a whole lot on this slide. It's obviously made for Zoom, so I'm glad I'm not doing it in person. But I wanted to highlight a number of things about these new whole life superior value products, and some of them are actually quite shocking. So what you'll see in that green line up above, our 20-pay product, we've had substantial increases in cash value, and they're actually designed such that the cash value will equal 50% of the face amount at whichever is later year 20 or age 65. This puts us into spectacular positioning. Somehow, even in doing that, we've managed to lower our premiums by an average of 15%. Now, that doesn't mean every client will see a 15% decrease. Some clients may actually see a little bit more and some may see less. But overall, across the entire portfolio, we've done a 15% reduction in the presentation, okay, or in the values. The positioning of the 20-pay is an exceptionally high cash value product, but at many ages, it's still extremely competitive in price. So what we've tried to really provide is, and I'll showcase an example a little bit later, one of the best cash values available in the industry on this product at a very, very strong price, in some cases the best price. What it allows clients to do, quite simply, is take a little bit of permanent insurance and tack it on to their term or put their term as a rider on it so that they can have some paid up that the premiums will stop by the time they retire and some term to cover their immediate needs as well. We really think it allows people to focus a little bit on that estate planning component while covering their debts or their immediate needs as well. And whether you want to look at the Superior Value 20 pen or the new Superior Value 100, they're very, very strong offerings. Both products have a cash value starting as early as the 5th year, so that can give you that automatic premium loan component and a premium payment either for 20 years or until age 100. Please note there is reduced cash or reduced paid up on both of those products as well. So we've really introduced or enhanced the cash values in the product. We've enhanced the premiums, and these products still have the same strong compensation you're used to as an advisor with Beneva. Very strong value, really wonderful incorporation into these contracts. We've also made some adjustments to our T100 and our enhanced T100. So when we look to reprice our permanent products, we kind of did the whole gambit. We really updated everything across the board. Those of you that were looking at T100 know that traditionally T100 is designed as the lowest cost entry-level product for our clients. It's a permanent solution at an extremely low cost. Unfortunately, that low cost typically comes with a few potential challenges. There's no cash value on it, so there's no automatic premium loan. There's no options if the client gets into a cash flow challenge. While still a wonderful option, it was really hard for us to present things like our enhanced T100 or our whole life product or even our universal life when our T100 wasn't competitive. We've now changed that by lowering the premiums in our T100 down as much as 9% or on average of 9%. So our T100 is now a competitive product. Having said that, I would still typically recommend people take a look at the enhanced T100 or the new whole life 100 or the 20-pay. And the reasoning is really simple. That enhanced term 100, the price came down as well, but it's a very minor increase in premium over the T100, and it gives you a cash value starting at age 75. Huge value there. The key element that we encounter, and I can speak from personal experience and share a story, my own father-in-law in his late 80s had a permanent policy. I was the advisor of record on it, was diagnosed with Alzheimer's, and actually went and liquidated the assets in his bank account. He took out all of the money because that's apparently a common thing for Alzheimer's patients to do. Now, I happened to be notified, caught it in time to be able to go back and make the back payments when those premiums were missed. But on a typical client in their late 80s diagnosed with Alzheimer's misses 2 premiums, their policy lapses and they can't reinstate. Having a cash value included in your T100 style product can keep that policy in force, giving you time to catch up and rectify those situations for your clients. a very, very valuable component. And it's extremely competitive in cost. So it allows people to get some of those bells and whistles of a whole life product at a much more restrictive or tighter budget for your clients. Really strong value overall. Um, let's take a look at some opportunities or what we might be able to do with some of these clients, whether it's personal or corporate. Some of them may occur in either circumstance. It's not really a major offering, but I think this is where we start with a lot of our clients. And when you think about products that provide guaranteed cash values, what can we do? So an example, when we're looking at a personal or a corporate situation, clients are looking for guaranteed protection on a predetermined death benefit. They want a set amount payable at a set time. Very simple, quite common. This is what we tend to say for our clients. Most of our clients, in all honesty, don't know exactly what they want. We need to help them understand that. In the corporate market, guaranteed protection is amazing, but it needs to be compared to the other alternatives that exist in the marketplace. Some advantages can really be things like flexibility with your premiums, so the ability to take a premium holiday by utilizing either automatic premium loans, to take a reduced paid up coverage, to potentially cash it in if the need no longer exists. Cash value might not be a priority, but it can be quite important when you're trying to potentially borrow against it or utilize that cash within your corporation. Okay. Where does having a permanent solution really work? When we're talking about a personal policy, we're looking at doing a number of different things. On a lot of limited pay, say a 20 pay policy as an example, lower premiums. One of the key advantages, maybe we want to take this out on a child. We want to look at a larger amount or even a small amount, but have a limited payment window. The idea of a 20 pay product is a phenomenal solution. It's fully guaranteed. It's going to establish a guaranteed cash value, and that cash value will be equal to half the face amount when the child retires. So it can be a very effective option. When we're looking at these things, when we're trying to determine our face amount, we're typically looking at somewhere in the 10 to 20 times salary is what we would consider or what we would offer to clients. If we're looking at funding tax liabilities, taxes at death, maybe we've got an estate freeze in place and we're trying to compare options where we know what a set death benefit is, where the set estate benefit is. Maybe we're looking at an estate equalization to try and top up after covering some of the tax bill on RRSPs or equalize the value of the house or the cottage. We may have a number in mind, and a permanent solution can be an optional or a wonderful option for them. Charitable giving can be a great scenario as well. I'm working on a charitable gifting case right now where the client no longer needed their term insurance, donated them to the charity, and the charity is doing the conversion to a permanent product. Frequently, charities don't like variables, so sometimes guaranteed products can be a better option. Well, I talked about an equitable distribution among family members. So trying to say, one child gets my business, one child gets my home, and one child gets my RSPs. Well, the home is fully tax-free, the business is taxable as capital gains, and the RSPs are taxable as income. Even though they're the same value that's being given to each child, they're not getting the same after-tax value. And another key element where we may look into insurance could be either a spousal or a child support agreement as a requirement. Very simple options, but they come up time and time again. And there are reasons that people do look at permanent products in many, many cases. Um, If we want to look at corporate is a much stronger story. A permanent solution with a predetermined death benefit is going to work in things like key person insurance. Now, key person is frequently a term insurance product, but not always. It may be when we're looking to resolve a tax liability or fund a buy-sell of partners or owners in the contract. It can complement some pretty attractive tax planning and estate freeze moving to preferred shares. We'll take a look at that one in a little bit more detail. And I want to take a look at a very simple case study, and then we'll look at a little bit more complicated one. And this, I think, is a really easy one that can apply to virtually everybody online. It's a simple overview, it's a simple presentation, but it's something many clients want. We want permanent coverage. We don't necessarily want a long cash flow requirement. I don't want to pay forever. We want some term coverage. And the reasoning for that is I have debts today But my hope is that I'm going to transition into more assets and a bigger tax bill in the future. So convertibility is important. This is where I probably should have included some of the slides as to the strength of Beneva's term insurance conversion wording. We do have the best wording in the industry, convertible to any permanent product offered by the company at the time. So you don't have to worry about which option might be available. They're all available. Very simple. That's continues to be true on all of the old La Capitale and SSQ products. Both had that wording. So you're free to convert to anything in the portfolio. Yeah. Um, when we're looking at term as our starting point, Beneva is exceptionally strong, whether we're talking 10, 15, 20, 25, 30, 35, or 40-year term. We have a whole host of options, and you can layer them by adding additional coverage layers if you want in the software. Very simple, very easy. Allow the term to meet the need for the client. Pretty simple option. Okay. But where things are really attractive, and I wanted to showcase just how competitive we've really gotten in some of these cases. Some of you may be familiar with LifeGuide. It's not the only comparison software out there, but it is one. It's one I'm familiar with, and it's one I actually have a subscription to, so I used it to check things out. Here's an example. I ran a quote a few days ago. If you can see on here, it was on the 14th, so this was last week, just after we launched the new rates a week ago today. We did a 35-year-old male, for $500,000 of term insurance. We went with 20-year term because it tends to be the one most people talk about. We added in a fully guaranteed 20-pay product. And if you'll note here, Beneva is the #1 option in the industry. I showcased the other providers to see where their values are. So our term was really competitive. We happened to be the best term rate in town, but our whole life superior value was also the best rate, which gives us the lowest cost. Now, I personally, and some of you may like this, you may not, when I was an advisor and I did personal sales, I never liked to sell the #1 company. And it was because I don't want to sell based on price. I want to sell based on value. And what I'd like to show you is the exceptional value that that product has. You're likely very familiar with Term Plus, the fact that it has, guaranteed insurability benefits, the extreme disability benefit, the ability to add our DI rider and other riders to the product. Huge value, huge components there. Our whole life superior value also has the extreme disability benefit built right into the contract, but even more so, it's got substantial cash values. So what I did here, this is a little bit more advanced in using a comparison software like LifeGuide. I took the software and actually exported. I used their side-by-side comparison or montage. Now there's a ton of information on this screen, and I'll apologize up front, but if anybody wants to take a screenshot or recreate it, you're welcome to do that as well. We will also be sharing a copy of the presentation for any advisor that would like to see it. The key thing that I'd really like to show here is the annual premiums indicated here. So anytime we do a montage, it went back to annual premiums, so that's fine. The annual premium listed here is actually a little bit higher than it is with Beneva than with our other companies. For some reason, when we did the quote on LifeGuide, they incorporate the policy fee back into the whole life superior value, so that premium is a little bit higher because they applied the policy fee here as well as on the T20. So close. If you were doing it as a layered approach, you would only have one policy fee, and the total premium would be exactly what I illustrated on this slide. However, when they quoted the whole life superior value, we added $5.40 to the superior value and deducted it from the term plus. Okay, for this comparison. So what you'll see here are some highlight reels. I look at year 20. At year 20, we've paid $28,000, about the same as with most of our other carriers, but we've got a $26,050 guaranteed cash value, the highest available anywhere in the market. I wanted to look out to age 65, which is at year 30, and point out a couple of numbers. Ours with the lowest premium has a $50,000 cash value, and that's because it's guaranteed. It's 50% of the face amount at age 65. So 50,000 is there. We're going to see that with Foresters. They're at about 33. We'll see Desjardins at about 35. We'll see UV at about 40. And some of you know the UV market will say, hold on a second. What about their high value product? It's right on par with ours there at 50,000. So we match the leader in the marketplace. It's the only year we're actually the same. I believe every other year we're a little bit higher. So We wanted to try and really take that leadership spot. There's two other 20 pays in the market that didn't make our top 6 list because their pricing was a little bit higher, but I included their values as well. That's the Sun Life and the Assumption products, just to get an idea of where things do stand so you can see the premiums. But it shouldn't be so much about premium and cash value. I think as advisors, we sometimes look for more numerical data, more details to really compare that. And what I wanted to highlight here, and maybe you can't see it as easily, is this component right here, where we say the interest rate or the internal rate of return of that product. So putting in 1402 every year for 20 years is equivalent to just under a 2.8% GIC as an investment for your client. Now, that's by far the best in the industry. We compare it to 1% here, 1.1, 1.8, 2.6, -1, minus 0.55. But what I think is really important here is this client has $100,000 of coverage over a 30-year period and a 2.8% GIC with preferential tax treatment. So you could view it as paying for 20 years for a 30-year term that actually makes you money if your client has the cash flow to do it. A very, very attractive option for clients that have the cash flow to be able to do at least a portion of their insurance in a limited pay product. And what this does is it really puts Beneva at the forefront of the truly guaranteed market. Our universal life really puts us at the forefront of the variable market where the client wants to take the risk and be invested in various investment options, or they can blend somewhere in the middle. Now, this really gives us a strong offering right across the board, and it makes it a very exciting time for me and my colleagues because we have a very, very exceptional story, regardless of what your client is trying to do. Now, the next option I wanted to highlight, this is a more corporate story. It's you doing a whole life 20, utilizing this as a case study in an estate freeze. So what are we doing here? For those of you unfamiliar with it, with a estate freeze, let's clue things in a little bit. We're going to think about a common corporate structure. We've got a parent that owns the shares. The fair market value of the company is about $1.5 million. These shares have a minimal adjusted cost base and paid up capital. So they started very, very small. They started from next to nothing and built up over time. So the parent's going to have a big tax liability on these cases at the time of death. We can assume the tax liability is going to be roughly 50% of that, 50% inclusion. Maybe we'll look at 375. I know that's not quite accurate. We have we have some capital gains exemptions that may be able to qualify, but they may have already utilized those. If the parent continues to hold the shares can increase, so does the tax liability. As a result, one planning strategy that many people will use is they'll do an estate freeze. So what do we do there? How do they bring the children into the business on a tax deferred basis? Where does the liquidity come from to eventually pay for some of those tax liabilities associated with the value of their shares? And how can they freeze the growing tax liability on the shares as they continue to hold them? So what solutions do we utilize? Our estate freeze is generally going to be the best option. What we do is we take the common shares and we freeze them and exchange them for preferred shares with the same value. We issue new preferred common shares to the children who will eventually take over the company, and the preferred shares have a fixed value at that 1.5 million. So we know exactly what the tax liability will be. Okay. Can make things very, very simple. When we look at our situation, the preferred shares, the fair market values there, the common shares, the fair market values there, we've got a very, very strong structure where a family trust may hold the common shares. Okay, if the parent completes the freeze, giving the shares to their children, they own the shares. They should be parties to the shareholder agreement to be able to trigger things going forward and create additional insurance. It's a consideration when it's implemented. Frequently, people will use a family trust. It's not required, but it's a very common strategy when we do a estate freeze, and we can walk you through some of that process. Essentially, the family trust creates a situation where you have up to 21 years to decide who should become the shareholder after a period of time. Why does this work so well? On the attributes of the freeze, the values are frozen at the fixed rate. They're redeemed over time. This can be what's referred to as a wasting freeze. So what that means is we may redeem them on a small basis each year at potentially a lower tax rate rather than planning for the entirety all at once. If we actually do manage to do the wasting freeze and kind of a drip approach or reducing the amount of taxes payable, they have the ability to either take reduced paid up coverage when the amount becomes small enough, or potentially cash in the insurance if and when they've wasted the entire value of the estate freeze. If the clients live long enough to liquidate shares on an interim basis, it can be a very, very attractive planning strategy for our clientele to use. Now, I want to look at some term conversion opportunities and what we can do, and we'll take a quick look at a little bit in the software. But our products are eligible for conversion. So we have the Whole Life Superior 20, the Superior 100, with guaranteed cash values, reduced paid up starting as early as year 5. We still continue to have our phenomenal YRT Universal Life or our new level costed Universal Life. Something I should point out, and some of you will be very pleased to hear, our level Universal Life LCOI has actually reduced by about 6.5% as well. As a result of repricing our other permanent products, we applied that to the UL also. So some of your quotes that you may have had outstanding pre-April 8th when this update came will actually look a little bit more attractive. Term 100 continues to exist. It's much more affordable than it ever was, and it does meet your permanent life needs in many cases. The Enhanced T100, I think, is a huge value product. It really is kind of a sleeping or a sleeper product inside the Beneva portfolio. It's kind of a 2.5% more expensive than the T100, but it typically has much better values. It's got guaranteed surrender values from age 75 equal to 50% of the premiums, and paid up coverage starting in the 10th anniversary, regardless of age, equal to the entirety of premiums. So if for some reason you no longer require the insurance, it's never considered wasted premiums on that product. Some considerations when we're looking at a conversion, just reminders. Conversion can be a wonderful solution for many of our clients who may have insurability concerns. Sometimes they just don't want to go through the process. Maybe they have white coat syndrome, they're intimidated. Not a problem. We do offer conversions on all of our products up until the 71st birthday. The conversion must be made before their 71st birthday. The only option after that is, unfortunately, a renewal. I should point out, however, we did launch, and most of you probably know this from last year, our exchange program has a conversion and carry forward component. So as long as your term has not yet reached its renewal, so this is a great news to clients who maybe have a 10-year term in year 9 or a 20-year term in year 19, as well as any time before that. But we offer the ability to convert 25% of the face amount and reissue the balance of the term as a new issued term product of an equivalent or longer duration. So that means your clients can really have lock in some and beat the renewal to a much lower premium than the renewal, as long as you bring them to act before that renewal date actually occurs. Okay, huge value there. Let me take a look at a couple of things in the illustration software just to highlight some features and values. So this is some really attractive components in our new Whole Life Superior Value 20 product. So I've done this example. It's I believe a 35-year-old, $100,000, same sort of premium we were looking at, but this is done as a monthly premium. We're going to see there's our total premium for the year. We still have the EDB. We have reduced paid up protection, and we're listing the guaranteed value before tax. But a couple of things I really want to point out, and that's why they're highlighted. We've got the end of year here. So at the end of year 22, we've got this little asterisk. And what the asterisk means is this is the year at which the guaranteed cash value surpasses the total premiums paid. Okay. We've also highlighted age 65 because it's guaranteed that at age 65, the guaranteed cash value will be equal to 50% of the initial face amount. So those two are very strong, and this page will be of huge value inside your product. The second page is a little bit more confusing for people, and I wanted to point this out because we've actually added this as a default page when you create an illustration. So anytime you do a 20-pay product, you're automatically going to get the tax report. If you don't want it, you're welcome to go into the Beneva, into report design, and turn that page off. The reason I say that is this section can sometimes be confusing for clients. We don't necessarily know what their tax rate will be. The default we include in the software is 30%, and it says guaranteed cash value after tax. Please note it's the guaranteed cash value after an assumed tax rate. So while we can guarantee the amount and we can guarantee the taxable amount, we can't guarantee what tax rate your client will actually have. Okay, so quite simple. We want to ensure that that's not a concern for people. It's very nice to also show the ACB. Those of you familiar with the ACB will know that we can take a policy loan up to the value of the ACB with no tax implications whatsoever. So yes, there may be taxes payable if we wanted to cash out this entire $33,000. 8,000 of it would be taxable, which means this $25,000 amount could be taken as a policy loan or an automatic premium loan with no tax implications at all. Very attractive. We've tried to highlight a lot of the information and showcase a lot of the value. Many companies don't really promote or talk about the potential taxes payable on a withdrawal, but since we've got the highest cash values out there, we wanted full and complete disclosure. If you don't want to show this page, again, you can turn it off in the report section to make things very, very simple. Okay. We've also updated our universal life illustration software, and I think this is really important to talk about. It's not the product we launched today, but I think it is important to highlight. We added in these 2 pages right at the beginning of every universal life illustration. They're going to talk about the different cost of insurance types and the different death benefit types, really in and from an element of full and complete disclosure to clients. So we not only enhanced some of our values on some of our products, we enhanced our cost of insurance on a number of the products, but we also moved to a more compliant illustration for your clients, showcasing all of the options. Some advisors may find this a little bit frustrating that now you have to go through all of the options, but it should just reinforce the decisions you've already made with your clients. Okay. I think this is nice. It doesn't, or it is included automatically. And now the product description in the Universal Life starts at the beginning of the document instead of at the very, very end. Okay. So a summary of some of the things we've talked about today. We wanted to understand the Beneva whole life features, how this can present many opportunities in different markets with some minimized cash flow requirements for clients. We wanted to solve the estate issue. Might not be only one product. We want to consider some case studies and future tax opportunities in the market. And I see that there are some questions coming in. I'm going to get to those in just a moment. I wanted to make sure we left a fair amount of time for the questions. Consider the case, take a look at term conversions to try and see what options exist. And let's talk about whether it was an old Le Capital or an SSQ in-force term. You can convert them all to benefit permanent coverage. You use the same form. It's that FIND 0116. It's available in the document center. And all you need to know is its policy change to start looking for it. If you want to document the form number, you can. I think it's worthwhile to point out the new enhanced Term 100 coverage. We've had it for quite a while, but many advisors didn't bother looking at it as the pricing was not competitive. It's an amazingly unique product with a fairly low cost of entry, but gives you a lot of the value add of a traditional product. And finally, our permanent insurance portfolio. So here's the issue ages, the descriptions of each of the product, that of course extreme disability benefit is automatically included in all of them when you can access a cash value and when guaranteed paid up protection is available and when we have the ability to do an advanced payment. Okay. So these are great. We've got some questions. I'm sure there's quite a few of them in here. So let's take a look at some of the Q&A. Jay, have you been tracking or answering any, or is there some we want to take a look at specifically?
Yeah, I've been going through quite a few of them, it looks like so far. There's just about, I think, maybe 4 or 5 that are still pending right now. So if you want to,
Okay,
tack on to them, Jason, go right ahead.
sure. So wonderful. We've got a few questions here. We've got, why does the, oh, I see that that was a modification. Why does the ACB go down in later years? It's really the calculation of how the ACB is is generated. That's fairly standard in a regular product. What we've got is the ACB is the premiums in minus the cost, or the net cost of pure insurance. So once we've paid a higher amount of premiums and the cost of insurance is still coming out in the underlying product, that will reduce the ACB over time. Ultimately, every contract should wind up with very close to zero in ACB. And what that means is eventually any withdrawal will be fully taxable. Eventually, any contract in a corporate structure will have a 100% CDA credit. Those are good things in the long term. Okay. Hopefully that made sense and answered that question. If you'd like a little more detail, we can address that as well. I'm just going to minimize this or stop sharing the screen for a moment so that I can see the questions in full size and see where we've gone here. Hopefully that answers that one. Can I elaborate more on term conversions? It went too fast if possible. Which document? Yeah, no problem. We can address that as well very easily. So for term conversions, we have the form is FIND011. I'm actually just going to open on my screen. We'll go into uh, the document center. Let me just share this screen now that I stopped it, and we'll go back in and show you where to find that. Okay. Where? What happened to my screen share option? Oh, there it is. There we go. We're going to share this screen. So you should be able to see our main site. So obviously we just go to Beneva, we go to advisors, we go into individual insurance and document center. And for the form, the easiest way to look is policy change. You're going to see here, policy change without evidence is how we would access a change form for conversion. And when we click on that form, it's going to look like this. Okay, so policy change, we can fill it in here. Where do we want the new policy or the amendment to be sent? You're going to tick in here that you'd like to do either a total conversion on a new policy. You'd like to do a partial conversion. Okay, and then fill in your details and attach an illustration to it. Very simple access. And we do have access to all of those products now, not just the original options. Okay. We had a great option here. Can't we withdraw cash as well? Absolutely a withdrawal. When we talk about the cash values and all of these options, we actually love it if the client wants to just withdraw the cash and take their money and run. The comment I've used for many years is it's almost like well, what's that show? Let's Make a Deal, I think was the show with Howie Mandel, where every year we're trying to essentially increase the briefcase and the buyout that the bank wants to give to let you cash out early rather than wait for the long-term benefit. And what we've done here is we're increasing that offer every year on what the client may want to take and run. We're happy to accommodate. If people want to utilize it that way, they can. It's fully guaranteed. It's a contractual option. But we did want to point out that there may be some tax implications. This is true with every company out there. It's not unique to Beneva. We may actually have slightly higher tax implications on the product, but that's because there's substantially higher value in the product. And the difference is what's the value minus the ACB. The premiums is what create the ACB, whereas the value in the product is substantially higher. Okay. Could I elaborate more? I've answered that question. When we get a policy loan, it's not taxable. That's not necessarily true, and it's actually a very, very common misconception. And I think it comes from a lot of the fact of people are seeing things in online and social media in these types of circumstances. Because in some places outside Canada, policy loans are not taxable. In Canada, we do, however, have tax-free death benefits. So while the death benefit is fully tax-free, a policy loan up to the ACB is fully tax-free. But because the policy can grow on a tax deferred basis, at some point, if you're just using it to shelter and not receiving the funds at death, there may be taxes payable. So a policy loan in excess of the ACB is triggering what's called a deemed disposition, the equivalent of a withdrawal, and will generate the same taxation as a withdrawal in Canada. This applies to whole life, to universal life, to guaranteed products with every company. It's based on the Tax Act, not based on Beneva. I'm just probably the first to bring it forward to many of you. Okay. And conversion, oh, we got another question here. Conversion of the term part will be the non-par or par whole life. So Yes, if we wanted to do the conversion, so I'm guessing this question means your um, is illustrating a conversion of the term, sorry, will be to either our non-par product or to our traditional T100 or to our universal life, and the term can be reissued. The balance of the term can be reissued. I hope that clarified that sentiment.
Hi, Jason. Everybody, I think they had a question about the brochure. I think they weren't able to see it when it initially came up, when you were sharing it. The last example you had with the brochure.
Oh, the policy change without evidence?
I believe so.
Oh, I didn't show that screen. I'm sorry. Let's bring this back in and share. Do we have it here? Let me go back and get you to it. So policy change without evidence is going to come in from here. We're going to go into Beneva by default. We're going to go to advisors. We're going to go to document center, and we're going to make things really easy and just type policy change to try and locate the form. I don't expect you to remember the number. Um, Most people won't, but we want a policy change without evidence. Conversion is a contractual benefit, so no evidence is required, and that's going to bring it up under all of the different products. It's exactly the same form. It makes no difference. It's a 12-page document, and you'll see here we've got the option to be able to include how do we want to send it? Do we want to send the new policy directly to the advisor? Would we like to send it to the policy owner? Who is the policy owner if we're making changes? What are we doing to the contract? The most common is going to be down here, a conversion. Okay, so we may look at a partial conversion, preserve the face amount, partial conversion on a new policy, conversion is CI, what are we converting? All of these are options within the contract. Okay, pretty simple option on what to do here and what we're trying to adjust. If you're doing exchange, we may want to do a conversion of a portion, so a partial conversion, and we may trigger an exchange program on that carry forward component. Okay, hopefully that was a little clearer. I apologize that I didn't share that. I knew I was walking through it on the screen. And let's see, I saw there was quite a few more questions coming in, so let's try and address what we've got here. Okay. Um, your benefit illustration software continues showing insurance costs well past age 65, even though the client overfunded in paying insurance. Okay, I think I'm guessing that's a continuation of a conversation you were having with somebody, Jay. Um, the
Yeah, it was just in regards to the case study. I believe it the case study you had that you were showcasing previously before.
okay, we can bring that back up as well. So in my case study, let's bring this back up. We've got different options here. So in this option, we showed premiums, and just to clarify this, the premiums only go until year 20. So the premiums stopped here, but the premiums were zero from year 21, which was age 40, or okay, which is after age 55, but the cash value continued to grow. I think this was the option we were looking at. Okay. Is there a contingent owner option for child insurance? Yeah, we actually call it, I think our term is a subrogated owner. And generally people should include a contingent owner anytime it's a children's policy. It's something that's very important to include because you want to ensure that there is an owner, not just the estate in the event of the death of the insured. Great option. Okay. Um, Another question. Here's a great question. If average life expectancy is approximately 84, 85, why is insurance calculated to age 100? It means the client's paying for insurance. They're never going to have the opportunity to use or receive a benefit. That's a valid concern, but we have to remember that there are people that are buying insurance, and Beneva actually sells insurance right up until age 85 on our YRT Universal Life. So an 85-year-old client can even still buy insurance. And I'm pretty sure if we were dealing with an 84-year-old, their life expectancy is substantially higher than 85. We know that life expectancy in that kind of 80s range is for anybody right from zero. As we get older, our life expectancy actually increases because we've already gotten past all of those potential early dates or challenges. So um, some advisors will try to illustrate to 85 or 90. When we talk about insurance, particularly for estate planning, we want to ensure that the coverage is actually there long enough for the client to receive the benefits. And this is why we typically illustrate to age 100. It's the conservative nature of insurance, um, in that people buy insurance to know that it's going to be there regardless. Okay. Um, I got another interesting question here. Is there a premium offset option with things like an ADO, additional deposit option in Whole Life Superior? There is not. So the Whole Life Superior product is pretty simple. It's fully guaranteed. It's you buy the face amount, you get your schedule of deposits, you know exactly what your numbers are right from day one. It doesn't have a flexibility or a variability of premium, but it can be a really nice anchor or base of a guaranteed component if you're interested in guarantees. For clients looking for flexibility of premium, I would generally recommend considering our universal life, and we can talk to your local wholesaler to try and discuss how and why that might work. We've got some really good questions coming in, and I think it's great that we left time to address them. What happens if a Canadian citizen moves away from Canada? That's a great question. And how exactly does it apply? So there's good news and bad news. A Canadian citizen leaving Canada has interesting opportunities. Unfortunately, depending on where they move, the story is completely different. As an example, we'll use the United States because it's the most common occurrence. In the United States, to a resident of the United States, you're taxed on your global income, and life insurance is considered income in the US, so all proceeds are fully taxable. This can be a bit of a challenge. There are other countries where life insurance is fully tax-free. So it depends on where you go on what the tax treatment will be. We can't really make recommendations to clients on their international structure unless we're familiar with where that international structure is. And most of you probably are not familiar enough with the tax treatment in other jurisdictions to really have that disclosure. Okay. I love this question. Social media is promoting infinite banking with corporate-owned policies. What's your view and how do we structure a corporate-owned policy? Well, infinite banking is a great concept. It does work very well. It works particularly well in the United States because their loans are completely tax-free. It can work here, but in order to do it, you generally want to work with either a smaller policy loans, not quite as much money, early in the contract, the life of the contract, or with collateral loans rather than policy loans, because the third party allows you to still have that completely tax-free loan. It's an interesting strategy. It can work well. What I think is really good about social media is it gets people talking about insurance for concepts other than just paying a death claim. And this is what we really want to try and bring our clients into the conversation on, is you want to work with an advisor, because unfortunately most social media isn't specifically designed for the Canadian marketplace. We have some of the best tax treatment of life insurance anywhere in the world. Our benefits are tax free. Our values grow completely tax free. Our proceeds are paid out tax free. But as a result of having all of those benefits, some of the strategies that might work elsewhere aren't as attractive in Canada because our policy loans are not 100% tax free. So I think it's a great option, and I think we can structure it. We can talk in detail on individual cases. Okay. Would a policy loan be taxable in the case of an IFA? In many cases, it could be. Again, that's a more complicated structure. IFAs are usually done with a third-party lender as opposed to utilizing a policy loan. Anytime there's a third-party lender, there's no taxation whatsoever. It's only when it's with the same company, when it can be deemed to be one contract. Okay. Um, Another really good question here. Do you think having corporate life insurance is a better solution than freezing the preferred share and using the trust? I think corporate life insurance is definitely the consideration. I don't know that it replaces doing an estate freeze. It may actually be held inside the corporation to potentially pay some of those taxes, as there are still shareholders. Um, Corporate ownership when it comes to life insurance is almost always more attractive to the client simply because most of our clients are small business individuals, and a small business is going to see taxation in the 10 to 12% rate. So even if we're paying with after tax corporate dollars, it's far less expensive to fund the insurance than trying to pay those dollars out personally. Any client with a corporation should always at least consider and do the comparisons with holding their insurance in the corp. I guess the one negative or huge outlier that stands with doing corporate ownership is what type of business it is. If it's a business that risks more litigation, the insurance proceeds may be at risk because you don't have definitive creditor protection when it's inside the corp. So that's one, I guess, story. I got a question here. Would you elaborate on a premium loan being taxable when it's over and above the ACB? I think we need another class. Yeah, I think that's probably true. So the key thing that I like to highlight when we do a policy loan or an automatic premium loan, there may be some tax implications. Generally, there's a little bit of ACB, so the automatic premium loan isn't a massive concern, but it does come up. But the key thing that we want to look at here is when we take a policy loan, any amount of that loan in excess of the ACB will be taxed on a pro rata basis. So that little component will be taxable. Okay. Um, yeah, and we can absolutely arrange discussions. So we've had a whole host of a flurry of questions. I can see now we've had 77 answered questions. I think that might actually be a record, but it's because I left enough time for all of the questions that have arisen today. We'd be more than happy to meet with advisors. I think Jay's contacting a couple of people who have asked for contacts to share some of their contacts with them. Collateral loans came up as a great question. A collateral loan, depending on the province, we have different options available. I work in Ontario. We do have a great arrangement with Duca, but they're Ontario specific. I have been in discussions with a national lender that is potentially available, and we're looking at launching that officially probably in Alberta and BC shortly. So you may want to keep abreast of that. The reality is the corporate or a collateral loan is not done by Beneva. Lots of companies illustrate the collateral loans. There are less and less companies doing collateral loans or actually have arrangements specific with entities. Some have recently left the market, but it is available generally for a client that has the assets. Their corporate banking person may be able to lend and just use it as an asset. Again, I work with Duca for clients for insurance because we know the people there and I've put advisors in contact with them. More than happy to do make those arrangements, but they are exclusive to Ontario. If you are looking at a corporate loan, it's generally a few years into the contract. They're usually for larger face amounts. Every company lets you illustrate them in their software, simply because loans against life insurance have been available for 50 or 60 years. But it's not every lender wants to lend against life insurance. It's an asset. It's a matter of trying to wrap people's head around the asset to do a loan. Okay. Um, so any withdrawal over and above the ACB is taxable, but loan over and above ACB is not taxable. A policy loan over and above the ACB is taxable. Okay. Any withdrawal over and above the ACB is taxable. So I want to actually clarify that because loans or a policy loan over the ACB also triggers tax implications. Okay. Um, is the policy loan not taxed when the policy is used as collateral and obtained with a different lender? Correct. So the policy is not taxed when it's collateral with a lender because the lender is a separate entity. They can't. So if we break this down and say, I have a policy over here and I go and take a loan against it from this institution, that loan is not income, so it's not taxable. But if I'm cashing out or putting access to the funds over here out of this tax sheltered vehicle, that does trigger taxation. And the reasoning is people would typically take advantage of, I have to assume, I don't know this definitively, so let me backtrack for a second. Generally, anytime rules exist, they exist because someone has exploited it in the past. So the assumption I'm going to make, and this is an assumption, I haven't actually done the research on it, is someone has likely borrowed against their life insurance to a point where they brought the value down, and then at the end when the death benefit was paid, it was tax free. they manage to get all of the money out on a tax-free basis during their lifetime. Life insurance isn't designed to allow you to access all of the funds on a tax-free basis. It's not a tax-free structure. It's a tax-deferred structure. Life insurance is tax-free when a death occurs. In many products, including our universal life, we've instituted the privilege in case of disability. So you can access it in the event of a death, you can access it in the event of a disability. But you can't access it from within the exact same contract to have a complete tax shelter available for your use in life and a contractual guaranteed access point on a tax-free basis. That would really just be circumnavigating the Tax Act. Okay. I have a question here. How does probate affect the UL? It doesn't. There is no probate on the universal life, so it's not there, and probate is now considered the estate administration tax. Um, Term exchange, I got a good question here. Can be done in the first 7 years. So yes, a term exchange can be. So let me clarify that because it seems like a complicated question. We have the term exchange program, and we have what I'm calling the conversion and carry forward. When we originally launched them, we launched them both as exchange program, and the terminology seemed a little confusing. So our traditional term exchange to exchange to any longer duration term policy can be done at any time during the first 7 years of the contract. No problem, you can switch for any longer term. Easy, simple. We have a secondary program we launched last year, which is a convert and exchange some term. That is allowed up until the renewal of the term policy. So a 10-year term, it's allowed in the first 10 years. A 15-year term, it's allowed in the first 15 years. And what that means is as long as it's during the first duration of the term, you can convert any amount of coverage and reissue 3 times the amount converted, obviously to a maximum total of the original face amount, on a newly issued at attained age without evidence product. So it means you're not paying the renewal rate, you're paying the new entry rate on that term if you convert a portion of it. Hopefully that makes things clean. It also wants to highlight the fact that our exchange or our exchange and carry forward allow you to do any longer duration term. And on the conversion and carry forward, you can also reissue the equivalent duration term. So hopefully that's clean there as well. And oh, we've still got a few. Okay. We've got lots of questions coming through. We're going to have to put a stop to it shortly, but I'm happy to address them for another 15 minutes or so if people do want to stay on the line. You've earned your credit, you've stayed online, you've qualified for it. Thank you so much for your time today. For those of you that do have to leave, I understand it is 2:30. I want to thank you for spending time with us. For those that do want to see the balance of questions that are coming through, you're welcome to stay. I'll take them for a few more minutes. Okay. Um, let's see what we've got here. What's the difference between a withdrawal against CSV and a loan? Okay, since withdrawal becomes income, it's taxable, but the loan is repayable, so it's not considered income. So the policy loan, when it's a policy loan from the contract, that is considered a deemed disposition when it's in excess of the ACB. Now, it doesn't really matter what I say, what another wholesaler says. It matters as to how CRA handles it and what the reporting is. Now, this is not a Beneva position versus a whoever other company position. It's simply a tax act positioning. Okay? So I don't really care what one company says versus the other. If you want to follow what another wholesaler says, you can apply that to us as well, but it might not be accurate. I don't want to badmouth anybody ever. I think we're all trying to do what's best for our clients, and sometimes we reason without necessarily having experienced it before. So I would challenge that comment. Um, yes, so when we do a collateral bank loan, we do have the ability to do it in a number of different ways. One of the examples that's being asked is, do they charge interest annually or on death? Typically, you'll have one of two options when you structure a bank loan or a collateral loan. You can either repay the interest annually. If you're doing it for an investment purpose, that's generally attractive because the interest charged is a deductible expense against the growth. So many people elect to do that. However, if you're trying to utilize it for income, there isn't an investment. It can sometimes be nice to defer it all the way to death. So the way that would typically be structured, quite simply, is you would take a line of credit for a large amount and draw against it. And as long as there's enough room on the line of credit for the withdrawal you want to make and the interest charges that are due, no in, no interest is required to be paid. They'll allow it to accrue in anticipation that it will be paid off at death. We will be sending a copy of the presentation to everyone who attended. Thank you for that question. Um, what would happen to life insurance policy on a corporate liquidation? That's a really good question, and it's one of the reasons why people need to pay attention to corporate insurance. As you'll recall, I did mention one of the negatives of owning your insurance corporately is it is exposed to creditors. So if there is a cash value in the policy and the corporation does bankruptcy or needs to be liquidated, they would actually cancel that policy and utilize the cash value to pay creditors. Okay. These can be very, very considering or concerning things for many clients. Um, Great. Investment funds, we've got a broad selection of investment funds inside the Universal Life product. Oh, I don't need to leave this screen up probably much longer. I didn't realize I was still sharing the screen, so maybe we'll stop that. But I did have a question on what some of the Universal Life option funds are, so I may showcase that for us. Oh, now I stopped the share. We'll try and go in and do that one as well. So if we look at our Universal Life, we don't want policy change. Okay, we've got a whole bunch in here. There's a lot of options, but what you really want to look at is the investment options. So I don't want to go in the document center. I want to come here under advisors and go to rates and returns. In here, we'll see the weekly products. We've actually got the Universal Life listed, and you can see all of the different options available and what those returns are. So the question was more specifically to index style accounts. So we've got all of these options. So an equity style might be an option for that. Oh, and of course I did it again and didn't push share. Jay, you didn't catch me in time. So here we'll showcase this here. We would go into advisors, go into individual insurance, rates and returns, click either on the investment product Universal Life or click on the weekly rates and returns where you can actually see what some of the returns are on individual products. Okay, depending on what you're looking for. Universal Life account returns. What do we want? Here's a monthly returns for our Universal Life accounts. These are some of the contracts. These are all of our strategies. And these are the indices we do have available. Okay, with their yields. Let's see. Um, okay. I have a question on trying to reach wholesalers. We can share who the wholesalers are, how to try and reach out. Generally, we have people like myself, the wholesaler. We've got the business development associates like Jay. Generally, BDAs are available during the day. Many of the wholesalers will support in the evenings. Um, so we're happy to try and support you as best we can. Um, I have a question on how can we switch funds inside the Universal Life. Um, Absolutely, you can make changes inside the Universal Life. You are allowed to make a couple of changes a year, and changes inside the UL will actually be a change form inside the document center. Okay. Wonderful. I want to thank, I want to read this comment just because, oh, Jay just got rid of it. Apparently someone thinks I have a soothing voice, so I'd like to thank them. I didn't get to see who to give credit to. I wanted to read that one. But I do appreciate everybody spending time with us today. I'd be happy to do a universal life training in the near future. I think our products are exceptionally strong. I think the value we bring as a company is an exceptional strong value in our portfolio of products, in the desire to really offer additional benefits to the clients and to try and support our advisors as best we can. You know, the reality is every prospect out there generally needs more insurance than they typically want. And we have a very difficult job of showcasing their need in a relatively calm way because nobody wants to talk about death of themselves or their children or their parents. But we have to talk about some of the tax implications so that people can move forward in a positive view, knowing that they've taken care of a terrible time. And we want to try and have exceptionally competitive products right across the board. We've got a few minutes left. A number of people have left. I thank those of you that have stayed, but I'm going to try and put on one additional comment here. It's not official, it's not a Beneva story, but I think it really showcases the value proposition that we've had as an organization. We started during COVID. We were the merger of two fairly large insurers to become Canada's largest mutual. We're looking for an ROI. Our target return on investment is 11%, substantially lower than every company larger than us. What this means is we have intense and immense value in most of our products baked right into them in the structure. We can meet our profitability margins by giving clients good premiums with added benefits for typically the same face amount. This is a very strong offering. I want to try and deal with kind of the elephant in the room, if you will. Some people have commented that some of the service levels have had some challenges in the past. And while that's true, I think it's kind of an interesting time in that as we merged to Beneva, we went through a whole host of processes. We lost some staff in the process, not because we fired people, but because some people elected to go on to other places. And we've had a consistent, ongoing job postings in some areas, in some of the service departments, trying to get a full complement of staff. I'm very, very happy to say that for the first time since we became Beneva, our in-force team finally has a full complement of staff. And what that means is some of you have experienced some backlog, but we're clearing out the backlog and we're catching up. So I'm trying to highlight a few things. One of the key things we did as Beneva when we started was we tried to develop some good products. We then moved on to have exceptional underwriting decisions. We've now tried to tweak and enhance our products while in the background trying to improve our service. I think it should be noted that as an organization, Beneva's desire within the next 5 or 6 years, kind of by 2020, 2031, 2032, is to be known as the best service in the industry. But in the interim, we have substantially advantageous products and amazing underwriting decisions to get you there while we build to that level of service we're moving towards. I want to thank you so much for joining us today. I do see there's a call or two that people have asked for me to call them back. I'll be doing that this afternoon. I do have another meeting at 2:45, so I'll call back shortly thereafter. But I want to thank you for spending your time with us today, for spending your time with me today. I'm more than happy to assist anyone I can. Our whole team is here to support you. At Beneva, we really are about trying to do good things for good people, whether that's your clients or yourselves as our advisor. Thank you so much for spending time with me today. Thank you for your interest in Beneva and your ongoing support. We are here to help you as best we can. I wish everyone a wonderful day. Thank you so much.